Please welcome the next team and the last one, Sunway University. A big round of applause.
Thank you. Good morning. Thank you.
A very good morning to everyone. We are from Sunway University, and today we'll be presenting our analysis on Westports. We believe that there are three major growth drivers for Westports. Firstly, its ongoing capacity expansion. Secondly, its tariff rate hike that will boost its margins. And thirdly, we believe that Westports will be a major beneficiary of the formation of global shipping alliances. This leads us to our strong buy recommendation on Westports with a RM4.92 target price, implying a 15% upside.
Now, what is Westports? With a 76% market share in Port Klang, Westports is a main transshipment and gateway cargo service provider. Westports is the biggest port in Malaysia, second busiest in Southeast Asia, and 12th busiest port globally. Westports has grown rapidly over the past 22 years with a throughput CAGR of 38%. Its biggest revenue contributor of 84% is from the container segment. Westports is located at Port Klang, which is situated strategically along the Straits of Malacca. Over 30% of global shipping traffic transits through these straits yearly. Westports' biggest competitors are Port of Singapore, Port of Tanjung Pelepas, and North Port. With a 6% CAGR in transits of Straits of Malacca and 7% CAGR throughput growth in Malaysia, we believe that Westports will continue growing due to their strong competitive advantages as follows. Firstly, Westports' location allows it to act as a gateway to the Klang Valley hinterland. It is connected to more than 350 ports around the world through approximately 140 mainline and feeder services. This allows Westports to act as a main transshipment hub for its global customer base. Secondly, Westports' tariff rate is one of the lowest in the container industry. Its transshipment tariff is considerably lower than PTP and more than 50% lower than PSA. Westports also has a world-class productivity of 35 container moves per hour compared to their industry average of 27 container moves per hour. Due to their strong competitive advantages, Westports has gained 76% market share in Port Klang and 17% market share in Straits of Malacca.
There are three main drivers for Westports' growth. Firstly, Westports' continuous capacity expansion. The 8th and 9th container terminals, CT8 and CT9, will bring capacity from 11 million to 16 million TEUs, a 45% capacity growth. Its completion by 2019 will ease capacity constraints, where we believe that utilization rate will exceed 75% through 2019. Management is confident in acquiring more land and a new concession from the government, which we believe will allow construction up to CT13 with additional capacity of 6.6 million TEUs. Secondly, the formation of two of the top three largest global shipping alliances will bring additional transshipment volumes to Westports. Ocean Alliance and The Alliance will both commence in April 2018. Westports has already been secured as a transshipment hub by Ocean Alliance and expected to be secured by The Alliance as well. We project TEU volumes will grow with a CAGR of 10% through to FY19. The third driver is the 15% tariff rate hike, which will boost Westports' margins. Rates have been constant for the past 15 years. And due to the captive nature of gateway containers, we believe that the increase will be readily absorbed. We project EBITDA margins will rise from 55% in 2018 to 59% by 2022 due to the operating leverage.
With strong container volume growth and capacity expansion in place, we project Westports' operational revenue to grow at CAGR 10% from FY17 to 19, boosting top-line growth. Core net profits are also projected to grow at CAGR 9% between FY17 to 19 due to margin expansions from an average of 31% to 35% in FY19. Westports is also consistently generating positive free cash flows despite intensive capital expenditure, and we project free cash flow generation of up to 800 million ringgit in FY19. Gearing is expected to rise to 0.7 times in FY17 and gradually decline post-expansion plans. Extra comfort is also gained through interest cover, which is expected to improve from 9 times to 13 times between FY16 to 19 as profit rises. ROE is also historically high and industry-leading compared to both local and international peers, which are all below 15%. We project Westport's ROE to reach over 31% in FY17 due to its strong financial position and performance. Dividend yield is also highly sustainable and attractive due to management's commitment to a high dividend payout policy of 75%. We project Westport's dividend yield to average around 3.7% between FY17 to 19, reaping financial benefits for investors.
This leads us to our strong buy recommendation on Westports with a RM4.92 target price, implying a 15% upside. We value Westports using a discounted cash flow model and corroborate our analysis using an EV/EBITDA and price-to-book value methodology. We believe that a discounted free cash flow to firm model is the best way to value Westports, given its strong cash flow generation. Our cost of equity of 8.2% is derived using a capital asset pricing model, which we base on the 4% risk-free rate of return based on the 10-year Malaysian government security yield. We arrive at a weighted average cost capital of 6.7%, which we use to discount our cash flows. In projecting our cash flows, we assume a revenue CAGR of 7% from FY16 to FY25. We assume relatively stable costs with the exception of rising fuel costs. Our oil price assumption is $45 and $6 to $55 from FY16 to FY18. Our terminal growth rate of 2.5% is based on a 0.5% discount to Malaysia's long-term inflation rate. Besides valuing Westports using a DCF method, we also value Westports using a EV/EBITDA and price-to-book value method. We peg our valuation multiple to one standard deviation above its historical average, given Westport's strong growth prospects going forward. We arrive at fair values of RM4.04 and RM5.04 and RM4.86, which implies a 1 to 2% difference from our target price. This small differential, we feel, is justification of the accuracy of our target price. At its target price of RM4.92, Westports is trading at a forward EV/EBITDA of 16.4 times and forward price-to-book value of 7.5 times. This is a premium compared to the industry average of 10.8 times EV/EBITDA and 1.45 times price-to-book value. We believe this premium is justified given that Westport's ROE is triple that of industry average and is expected to show positive earnings per share growth in FY16 and FY17 compared to its industry peers that are expected to show negative EPS declines in FY16.
Here, we will highlight Westport's three main risks. Firstly, consolidation of shipping companies. During 2016, there were mergers and acquisitions involving our two biggest clients. However, we believe that Westports will be able to benefit from the dual hub policy adopted by the shipping companies. Secondly, weakening of global trade outlook. As 75% of Westport's volume are transshipment, this would affect Westport's growth going forward. But we believe that the key growth drivers will allow Westports to ride through any weak trade environment in the near term. Thirdly, potential competitors, namely Pulau Carry, which is expected to have a capacity of 30 million TEUs. However, the first phase of this project may take up to 10 years to be completed, which is a few years after Westports achieve full capacity. Next will be the Malacca port, which is expected to more likely to be a crude oil terminal. Besides, new ports will take years to fully develop port operating capabilities. We have performed a scenario analysis taking into consideration the upside gains and downside risks. Our bull case scenario implies a revenue CAGR of 7% with a double-digit volume growth. This gives us a target price of RM5.25, which is an upside of 23%. Our bear case scenario incorporates expected losses from major customers. Nevertheless, we project a target price of RM4.43, which is an upside of 4%. We believe that there are future for upside gains to our target price, whereas downside has been capped. In conclusion, Westport is a great company to invest in due to its three key growth drivers, which are formation of shipping alliances, continuous capacity expansion, and tariff rate hike. This leads us to a strong buy call with a target price of RM4.92, implying a 15% upside. Thank you. We are now ready for your questions.
Thanks very much for your presentation. Just a question from me. In your presentation, you mentioned that EBITDA margins will continue to expand. You're looking at about 59%. Is that realistic, given that they're also going to incur capexes? Thanks.
Thank you very much for your question, Mona. Yes, that's realistic because even though they are incurring capex and then depreciation will go higher, but nevertheless, all these are fixed costs. And as volumes expand and revenue continues to expand, due to the operating leverage of the port business, margins will continue to expand as well.
Interestingly, one of your major drivers of growth, as you have on your slide there, is continuous capacity expansion. It is a port.
Yes.
It can't continue forever. Beyond CT9, where is the growth coming from?
Thank you, Panik, for your question. Yes, you're right. It's not continuous. It's not going to continue on forever. So our financial model, we project growth coming in from CT8 and CT9. It will stop there, but there is continuous upside gains because Westports can acquire another concession and acquire more land. In fact, they are very confident in it in our discussion with management. So the addition of more land and a new concession will bring a possible TEU volume of 6.6 million, and they will be able to continue to construct up to CT13.
In terms of your shipping alliances, you say you will benefit from there. CGM is actually moving 1 million TEUs to Singapore because they own part of PSA. So where is that benefit coming from?
Thank you for your question, Mr. Liu. Because we believe that Westports is actually having a bit of a bottleneck at the moment because their utilization rate has exceeded their comfortable level of 75%. With CMA CGM removal from the operation removal to PSA, it actually allows more other companies, especially from the Ocean Alliance, to bring in their volume. And because CMA CGM is a big major customer, that's why they have superior bargaining power over the shipping management fee on what amount they will decide on. That is why when we allow other smaller shipping companies to come in, Westports may benefit from a higher margin.
In addition to that, if yes, CMA CGM is moving 1 million TEUs over to PSA, but because the Ocean Alliance will be using Westports, so new customers such as OOCL and Evergreen will be bringing in new volumes, which we believe will be more than able to offset the loss of volumes to CMA CGM. Besides that, we also expect the Alliance to use Westports either as a dual transshipment hub or a single hub in itself. And this will bring in new customers such as Hapag-Lloyd, such as Yangming, K-Line, NYK. All this will come into Westports, and we believe that Westports will be able to ride out all these short-term headwinds.
And why do you price it at one standard deviation above historical mean?
Yeah. So
shouldn't that usually share prices or valuation reverts to the mean?
Yeah, it would. But given Westport's strong growth prospects going forward, especially in the near term, this year the Ocean Alliance and the Alliance will come into play, and this will bring in a lot of short-term volume boost it will add to the long-term growth for Westports, but you also bring in a short-term boost because when Ocean Alliance comes into play, they will have to reroute their shipping routes and transfer additional boxes to Westports. So the short-term growth looks very strong. Therefore, we believe that they should be trading at one standard deviation above its long-term average.
What impact do you think one belt, one road policy would have on Westport?
Thank you very much for your question. If you look at the One Belt, One Road policy, we believe that it's good for trade overall in the Asian region. And being good for trade overall in the Asian region will benefit Westports, with it being the most cost-competitive port, as well as the fact that it's the most productive port along the Straits of Malacca. If you look at specific instances where it will benefit Westports, we can talk about the ECRL, East Coast Railway Link, that is being built from the Port of Kuantan to Port Klang. And we believe that this is a way for China to diversify away its risk from purely relying on PSA. So we see the possibility, China also owns a stake in the Port of Kuantan. We see the fact that they will use Port of Kuantan, and this will bring volumes through the ECRL to Port Klang and help it grow its volumes and boost growth in the short term and in the long term as well.
Can you comment a bit on the operational side? Excuse me. Cost structure for Westport, for the operations.
Just to clarify your question, are you asking me the different components in the cost of sales?
It can be. possibly, what is the cost structure when you talk about Westport
Okay.
from operation perspective?
Okay, we are talking about there is the cost of sales segment and there is also the fixed cost segment. So fixed cost segment can be admin costs, your depreciation and your amortization. And if you talk about cost of sales, we're talking about marine services that forms part of cost of sales, fuel costs, for example. And we believe that we believe that fuel costs will rise continuously in the next 1-2 years, given that oil price in the rising oil price environment. So we have projected into our calculations. Marine services, fuel costs, the specific container services as well, because they have to transfer the containers from the ship to the storage area. Manpower is a very important cost. So they have been.
I think the question is the breakdown.
Okay, the specific breakdown. So fuel cost is less than 10%. Your depreciation amortization is around 40%, and your manpower cost is roughly 20%. So that makes up roughly 70% already.
In terms of your tariff, why is it always lower than even your competitors down south, PTP?
So the tariff rate ceiling is set by PKA. So that's what they decide. But we have flexibility. Westports has flexibility to decide exactly what tariff they want to set. So I believe that they set that tariff rate cheaply. Number one, because they have productivity. They are very productive. So they are able to drive the volumes. And when you're able to drive volumes, you can
rates
accept
and
a lower
productivity
margin.
doesn't go together.
Oh, because you can accept a lower margin. So if you can price it lower, accept a lower margin, but you drive your productivity so you can gain more sales in terms of volumes. Yeah. So they're cost competitive as well. Otherwise, PSA being a global shipping hub, why would people go to PSA? Why would people go to Westports when they can go to PSA? So the main differentiating advantage, one of the main differentiating advantages is our price in Westports.
So what will actually change your buy call? I know you have your bear case here.
Yeah.
But what will actually change your call from a buy to a sell?
Much weaker than expected volumes coming in from Ocean Alliance and D Alliance. Let's say we expect D Alliance to start using Westports, but if they will not use Westports, then there is the possibility that we will change our buy call to a sell call. In addition, we also expect UASC not to move volumes from Westports to Port Singapore. But should they do so, given the recent merger, then it will change our buy call to the sell call as well. But we have already incorporated all these risks in our scenario analysis. And in our scenario analysis, despite the changes, as you can see in the bear case, even if these changes were to take place, the downside for Westports is still capped because we believe that the market is pricing in the worst in Westports' share price currently. If all these risks come into play, Westports' target price will be RM4.43, still implying a 4% upside and 7% total return.
Out of your target price 492, how many percent is attributed to terminal growth?
Out of the target price of?
Because your target price is based on your DCF, right?
Yes.
And you have certain assumption, terminal growth rate of 2.5%.
Yeah.
Right? So how many percent of that target price is due to your terminal growth rate?
How many percent of our target price is due to?
For example, right, the first few years of your DCF, you have very specific assumptions that you have built in. Beyond that, you use terminal growth rate.
Yep.
So I'm asking you, how many percent of that price?
Yeah, we think it's around, probably around 380 for 380 for the base price, and then an additional 92 cents plus 20 cents, RM1 and 12 cents for the additional terminal growth.
How many years did you use for the first?
So our projections, we specifically projected from FY16 to FY25, a 10-year projection rate. And then our terminal growth is from FY25 to FY54, the rest of Westport's concession.
All right, 10 minutes is up. Judges, any more questions for them? No more? Okay, thank you very much, Sunway
Thank you so
University.
much, everyone.
All right, big round of applause.